Welcome to the Moving Markets podcast on Tuesday, the 31st of March, with me, Bernadette and Anderko. Well, the war in Iran is in its fifth week and the effects continue to be felt in financial markets as well as everywhere else. And this morning, my colleague Mike Rauber will be bringing us the latest markets news. And then I'm going to be joined by my next generation research colleague, Dr. Damien Ng, for a look at the future of healthcare, how routine screening could improve early diagnosis and reduce hospitalisation, and why biopharmaceutical firms are increasingly adopting artificial intelligence to boost drug discovery. But first, the markets headlines from the last 24 hours. Good morning to you, Mike.
Good morning, Bernadette.
Why don't we start in Europe, Mike? Yesterday it was revealed that German inflation accelerated sharply in March after the Iran war boosted energy costs, supporting the idea that the European Central Bank will have to raise interest rates.
German consumer prices rose 2.8% from a year ago, the highest level in more than a year. Money markets anticipate a rapid reaction from the ECB and are leaning toward a rate hike already at its April meeting.
But despite this strong German inflation print, not only did Germany's sovereign bonds rally, but indeed bond prices globally moved higher, didn't they?
Yes, so Monday's global investment narrative shifted slightly from inflation worries to concerns about growth. Now, this was supported by weaker than expected European data. Switzerland's KOF leading indicator and Eurozone business confidence both declined in March. To put yesterday's move in the bond market in perspective, now while yields were down, the 10-year US Treasury yield is still up 40 basis points this month, a striking increase.
But comments from Fed Chairman Jerome Powell also supported the bond rally, didn't they?
Absolutely. So he emphasized that the central bank has limited influence over supply-driven price spikes, such as the war-related jump in oil, pushing back against expectations of imminent rate rises. Traders quickly unwound last week's pricing of US rate hikes.
Okay, US WTI crude closed above $100 a barrel yesterday for the first time since the war began. President Donald Trump warned that he would target Iran's energy infrastructure if no deal is reached.
In typical art of the deal style, the comments added to market volatility. Oil prices held firm as more US troops arrived in the region and Iran-backed Houthi militants in Yemen joined the conflict. West Texas Intermediate futures climbed more than 3% to settle near $103 a barrel, the highest since July 2022. Brent crude is heading for a record monthly gain, up over 50%, while European benchmark gas prices are up sharply, more than 70% on the month.
Okay, against this backdrop, equity markets were pretty mixed at the start of the week. Europe was generally solid, with the Euro Stoxx 600, FTSE 100 and the DAX all rising 1% or more.
But the markets did weaken in US afternoon trading. The S&P 500 fell 0.8% and the Russell 2000, that's the small cap index, lost 2%. Memory stocks led the decline. They are down about 25% this month, their worst months since 2005. But software, utilities and financials all posted gains yesterday. The VIX, Wall Street's fear gauge, closed above 30 during the session. Now, what I found interesting, Bernadette, traders also pointed to cleaner positioning, weak sentiment after a sharp global equity drop this month of 9% and quarter-end flows as contributing factors to yesterday's moves.
Okay, then moving across the pond, Asian markets open to mixed signals. According to reports, the US president is considering exiting the war without the Strait of Hormuz having been reopened, but is also weighing a military move to extract Iran's uranium. Iran also struck a fully laden Kuwaiti oil tanker near Dubai. How have the markets responded?
The Japan's Nikkei 225 is down 1.4% and China is down around 0.5%. Meaning the MSCI Asia Index has now erased all its gains for the year amid this month's sell-off. But we did get some encouraging March economic data today. China's manufacturing PMI returned to expansion, and in Tokyo, consumer prices, excluding fresh fruit, rose from a year earlier, but at the slowest rate since April 2024.
And gold is up this morning by more than 1% to $4,570 an ounce.
At the start of the war, investors sold gold to raise liquidity, which put pressure on gold prices. Once that forced selling eased and gold was near the key 200-day moving average of $4,100 an ounce last week, it seems that buyers stepped back in. It is up 10% from last week's low and is up for a third straight day.
All right, then looking ahead, what are we scheduled to expect today?
In Europe, we just got German retail sales for February. They were down much weaker than expected, minus 0.6%. Economists had expected a rise of 0.3%, so clear growth concerns even before the war started. Later today, the focus will be on flash Eurozone inflation data, and in the US, we get US consumer confidence and the closely watched job openings and labor turnover survey, or also called JOLTS. Now, finally, markets appear to have taken the US president's latest comments positively. European and US equities futures are in the green.
Super. Thank you very much for the market update this morning, Mike.
Thank you very much for having me, Bernadette.
Okay, now it's time to turn the talk to healthcare. Good morning, Damien. Thank you for joining me today.
Good morning, Bernadette.
So we're seeing some fascinating intersections between healthcare innovation and broader market trends, Damien. Why don't we start with a really crucial area, the link between diabetes and heart failure? Recent trials are highlighting a concerning overlap, aren't they?
Absolutely. It is a really important development. A recent study called the Tartan HF trial revealed something quite eye-opening. Around 25% of people living with diabetes may also have early signs of heart failure without realizing it. And when you think about the scale, more than 800 million people worldwide have diabetes. That overlap becomes incredibly significant. What is particularly striking is that these people weren't people with obvious symptoms. They weren't necessarily breathless or fatigued in a way that would set off alarm bells. Instead, researchers used a simple, widely available blood test that measures NT-proBNP, which is a biomarker telling us when the heart is under strain. They paired that with a standard heart ultrasound, and suddenly all these hidden cases came to light. So the takeaway isn't doom and gloom. It's actually encouraging because it shows that early detection is absolutely possible using tools we already have. And that could make a huge difference in long-term outcomes.
Yeah, and this isn't about a new disease, but more about a better way of detecting existing conditions, right?
Exactly. And this is what makes the finding so important. Heart failure has a way of creeping in quietly, especially for people already managing diabetes. So many don't really realize anything is wrong until symptoms become hard to ignore. That's why early detection is such a big deal. If clinicians can spot the warning signs sooner, they can intervene earlier, avoid unnecessary hospitalizations, and really improve long-term outcomes. What is exciting here is that a simple blood test can flag this hidden risk. It's not some complicated new technology. It is something we can already use today. And naturally, this kind of insight could spark more demand for diagnostic services and over time, open the door for more targeted treatment options.
And beyond diagnostics, we're also hearing about a surge in artificial intelligence within the pharmaceutical sector. How is AI reshaping the landscape of drug discovery?
It really is a transformative shift because for decades, drug development has been known for being slow, incredibly costly, and frankly, a bit of a grind. Now we're seeing biopharma companies turn to AI to speed up the entire process from identifying promising molecules to predicting how they'll behave in the body. And this week, we've seen a standout example, a major partnership between Eli Lilly and In Silico Medicine valued at up to $2.75 billion US dollars. The vision behind it is simple and powerful. Use advanced AI platforms to dramatically shorten the time it takes to design and test new therapeutics. If it works as intended, it could reshape how quickly new medicines reach patients.
Okay, that's a considerable investment, but what specifically does AI bring to the table?
AI brings several powerful capabilities to the biopharma industry. First, it can analyze enormous data sets such as genomic information, clinical trial readouts, scientific papers, and uncover meaningful patterns far faster than any human team. Now, this dramatically speeds up the process of identifying promising drug targets. Second, AI enables rapid molecule design, helping researchers predict how a compound will behave in the body and whether it's likely to be safe or effective before they ever synthesize it in a lab. Third, AI tools are beginning to reduce reliance on animal testing by creating more accurate computer-based models of human biology. Altogether, AI offers a faster, more precise, and more cost-effective path to discovering new medicines.
Okay then, Damien, are these advancements in healthcare having any noticeable impact on investor sentiment?
Certainly, and investors are absolutely paying attention to this shift. What we are seeing is the convergence of two powerful forces: better diagnostics that catch disease earlier, and AI-driven drug discovery that speeds up the development of new treatments. Together, they signal a move toward a much more proactive, personalized style of healthcare. From a market perspective, that creates real opportunities. Companies working in diagnostics, biotech innovators pushing next-generation therapies, and even technology firms building the underlying AI tools are all positioned to benefit. You can feel the optimism in the sector right now. Banks are reporting growing interest in related stocks and specialized healthcare or AI-focused funds, reflecting the belief that this transformation is only just about to begin.
Okay, then looking beyond healthcare, are there other sectors experiencing similar technological leaps?
Pretty much across the board. We are seeing a huge wave of innovation as AI and machine learning filter into almost every sector. In fintech, these tools are streamlining everything from payments to risk assessments. In manufacturing, they're optimizing production lines and reducing waste. And that's just scratching the surface. The pace of change is so fast that both businesses and investors have to stay incredibly adaptable. The opportunities are expanding quickly, but so is the need to keep up.
Well, Damien, thank you for keeping us up, and thanks for your insights today. Fascinating.
Thank you very much, Bernadette, for the invite.
Well, that concludes today's podcast. I'd like to say thanks again to both Mike and Damien for joining me today, and of course to you for listening. Please do tune in again tomorrow when Helen Freer will be here as your host with more of our experts to discuss what's moving markets. Don't miss that. Meanwhile, good luck today and goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.